All right. Let's get rocking and rolling today. Welcome, everybody. It's glad to have you. This is the lab for our university class. My name is Lan Turner, and I am the instructor down at Utah Tech University. Everyone is welcome. Just because it's a lab for the university doesn't mean the whole world's not welcome. Anybody who's on YouTube can come and join in. You're all welcome. But in particular, we're working, this is the laboratory class for what we talked about last night in class. So last night, we started to discover options. All right. So it was the very first class, an introduction to options. And then we have a follow-up class on Wednesday. And then we have a final class on Friday down at the university. So we have a 3-day class on options. Now, I can't teach you everything that there is to know about options in 3 days. All right. So you're going to have to keep coming to the labs, and I'll keep doing them if you promise to keep coming. All right. If you stop coming, well, there's no reason for me to keep doing them. So I need you to keep coming to the labs, and we'll keep studying and to keep working, and we'll keep working together. And I'm here for you to help you learn how to do these silly things called options, and of course, other types of trading as well. In the lab, we do all kinds of trading because at the university, we teach all kinds of things about stock trading. Stocks, futures, Forex, foreign currency, day trading, we do it all. All right. So that's what this lab is for, is to help people get a little bit more familiar with those types of trading strategies. And today, of course, we're going to talk a little bit about options. So what we're going to do is we're just going to go look at some very popular markets. Up here right now, I have the Mag 7. All right. So Mag 7 stands for Magnificent 7. It's the 7 largest tech stocks in the industry. So we've got Apple and Amazon, Google, Meta, we got Microsoft and Tesla. That makes the Mag 7. And then I got a couple others in here that just happen to be in the list. We got United Health in here. We had in a previous class, we had some trades on that one. We've got NVIDIA, which is part of that Mag 7. I've got MAGS, which is actually a Mag 7 ETF, exchange traded fund. So if you wanted to invest in all 7 of the Mag 7 with one fell swoop, you just buy MAGS, and that's what the MAGS does. All right, you just buy that. Now you have some of all 7 of the Magnificent 7. You don't have to go out and buy them individually yourself and try and manage that portfolio. You just buy this one, and you got all 7, and away you go. All right, so it makes it easy. But we can trade options on all of these. All right. We've also got the Dow in here. This is something that we like to look at. We'll clear out all of our drawings from last class. And then this is just the Dow 30. So that's a fun one to look at. We can also, we like to look at the indexes. So we're going to come in here and we're going to pull up the Qs. This is the NASDAQ. All right. So the NASDAQ ETF. We're going to also look at the SPY, which is the S&P 500. And what's the other one? We got Russell 2000. So the Russell 2000 is, we're going to find the symbol here, if it'll pop up for us. Come on, track and trade, pop up for us. It didn't like that. I put Russell. Let's just put Russell. There we go. So the Russell 2000 in the stock market there's one there called RUT. I think there's another one I would like. Like there's one that's already got covered calls on RYLD. We could go look at that one and see how it performs just for fun. Not in this class. That would be a high income dividend ETF. Russell Investment US Cap Global Russell 2000 ETF RSS. I guess we'll do RUT. I thought there was another one in there. All right, let's do that one. See what that looks like. Russell 2000. Okay. That doesn't like to. Says it's retrieving data. We'll let it go and go for a minute. Let's start up here. We started with Apple last night in class. So let's not do Apple again. Let's do Amazon. All right. Amazon's just kind of going a little bit sideways. Now, when we trade options, remember, we're going to do a call option or a put option. There's only 2 types of options, but we can buy a call or we can sell a call. We can buy a put or we can sell a put. Now, remember, an option is basically, it's like buying a house. When you buy a house, you put down some money to hold that house. All right. So that little piece of money that you put down is called the premium. All right. Or in real estate, there's a word for it, and it just slipped my mind. Come on, somebody pull it up and I'll give you a book. when you're in real estate and you put down your money, that's called a, oh, my brain is too early in the morning. Come on, earnest money. There we go. Thanks, Dennis Kelly. Earnest money. So you put down earnest money on a house. All right. So you put down earnest money on the house, and then that is like an option on a stock. So it's basically the same concept. You have the right, but not the obligation to buy the underlying asset. So if you put down earnest money on a house, you have the right, but not the obligation to follow through with the purchase of the house, right? But if you do the same thing with stocks, it's just an option. That's what earnest money is. It's an option on a house. Gives you the right, but not the obligation to buy the underlying house. All right. So if we're going to do the same thing with options with Amazon here, we have the right, but not the obligation to buy the underlying stock. Now, one of the big differences between real estate and the stock market is that when you put your money down on real estate, you put your $2,000 down, that earnest money, I mean, technically speaking, it doesn't go up and down in value. It just remains the $2,000 that you put down on it, right? So you don't buy and sell your earnest money. But in the stock market, we do. The earnest money or the options value goes up and down if the market goes up and down. So we don't have to actually exercise our right and take control of the underlying stock. We can just buy and sell the options themselves, all right, the earnest money. Because if the market, if we buy a call option and the underlying stock goes up in value, well, our earnest money or our options premium will also go up in value, all right? But if the market goes down, let's say that we buy a call option and the market goes down, well, the maximum amount of money we can lose is just the earnest money that we put on, just like in real estate. If you don't go through with the deal, well, you lose your earnest money, and the guy who sold it to you, which is the homeowner, gets to keep that earnest money because you didn't go through with the deal. So the reason you might not go through with the deal is because you changed your mind on the house. Maybe the house lost value while you held the option. You couldn't get funding, whatever. There's many reasons why you might not go through with the deal. Well, in trading options, you don't necessarily have to ever go through with the deal, all right? Because we'll just trade the premium of the option. That's what gives us the leverage. So if we're going to come in here, and let me clean up some of these lines in here. We got a little too many lines. We got moving averages. We'll just move those. We got the Bollinger Bands. We'll remove those. Was that Bollinger Bands? Oh, Bulls and Bears. We'll remove the Donchian channel. So all we have is just kind of, well, we kind of need let's do Bulls and Bears. We'll leave that one on. All right, so we're going to take a look at this market, and we can see it's just been going sideways for the last little while. And so we have to analyze. A lot of times people think, well, they ask me, Len, do I have to learn how to trade stocks if I'm just going to be trading options? And the answer to that is, do I need to learn how to drive a truck if I'm going to just drive a car? Or vice versa. Do I need to learn how to drive a car if I'm just going to drive a truck? It's the same thing. I mean, you have to know how to trade stocks because an option is just the right to buy the stock, or the option is a right to sell the stock. So you need to know how to trade stocks because that's what you're trading with options. All right. So the option is the right to buy the stock. That's what it is. All right. So you need to know how to trade stocks. So most of you have taken my stock trading class, and you've gone through and you've learned a little bit about technical analysis, right? We know when markets go up, we know the rules of a rising market. We know the rules of a bullish market. Higher highs and higher lows makes an uptrend. Lower highs and lower lows makes a downtrend, right? And in the process of making higher highs and higher lows, the market will make these reoccurring price patterns, right? So little ABCs, 1, 2, 3s, triangles, wedges, those types of formations. They're just little markers along the way that help us identify when the market might break out to the upside or the downside. That's called, set up some triggers. So we have count, measure, set up, trigger, and follow through. So we need to know how to trade so that we know when it's the right time to put on an option. Now, you can buy a call or you can sell a call. You can buy a put or you can sell a put. Now, we're not going to get into the selling of calls and puts today. We'll do that on Wednesday. All right. That'll be our Wednesday class. And then on Thursday, we'll do a lab where we're going to sell some options here in combination with buying some options. And that's where we get into option strategies. You don't just buy calls eyeballing themselves. Now, I would say 90% of traders who trade options, that's all they do. They just buy calls. All right, which is fine. You can do that. And I know some people who've made a lot of money just buying calls. It's perfectly fine. They think the market's going to go up, so they buy a call. If the market goes up, well, they make money. They liquidate their call because the premium of the option went up. They made some money. Great. That's how you do it. If you think the market's going to go down, you can buy a put. So you buy a put, and then if the market goes down, well, the premium of the option goes up in value. And so you sell it and you make money. You don't have to ever really take control of the options themselves or of the underlying stock themselves if you don't want to. But if you want to, there's ways to do that. There are some very unique ways of taking advantage of stock if you want to actually buy the stock using the options. And so we'll do that too. We're going to do that on Wednesday. All right. But option strategies. So if you've probably heard of things like iron condors, butterflies, straddles and strangles. All right. There's a whole bunch of them. I got a little book here. You can see it's called the 21 S&P 500 21 strategies for proven strategies for trading options. And so there's like 21 approved exchange traded option strategies, and you can see them all here with this little card. All right. So there's lots of ways you can trade, but it's a combination of options. All right. So you'll buy a call and you'll sell a put, you'll sell a call, you'll buy a put. You do all kinds of different things, and they're different. We give them fun names. All right. That's all they are. They're just fun names for different ways of buying and selling calls and puts, because there's only two options. There's calls and puts, but you can buy a call and you can sell a call. You can buy a put and you can sell a put. So when you do combinations of that, then we give them funny names like iron condor or butterfly, or, again, there's 21 different names. You want to know some of the names, some of the fun ones. So they got butterflies. We got just a short put, long put. That's just buying and selling the options, just like we were talking. That's what we're going to do today. There's straddles, there's strangles, there's back spreads. There's, again, like I said, there's condors and butterflies. Those are the fun ones. And we'll get into some of those things. All right. But the one that I'm most interested in teaching you is the ones that they use in the high yield funds that we like to trade. So we like to trade the Yield Max funds, the Granite Share funds, Roundhouse funds. Those are the ones that give you the high yield. Those are for income generation. And the reason we like to trade those, we like to hold those in our portfolios, is because they trade and they give us high yield, high dividends. All right. So we get paid every Friday, or once a month. We get a nice big paycheck from our portfolio that trades those high yield funds. And the reason that they can produce those high yield funds is because they're trading options. All right. They're not just like a traditional dividend would come to you from the profits of a company. So if Apple makes money, well, every 3 months, they might give you a little share of that money that they made. All right. It's called a dividend. Usually it's so tiny, it doesn't really register on your radar, just pennies. So we call them why bother. Right? Why bother? It's so tiny. The growth of the movement of the stock will wipe it out in an hour. All right. The usually dividends are so tiny until you can get a huge portfolio, giant portfolio, millions of dollars, and then those dividends start to become something you could live off of. But with these other funds, they have really high yield. They have high dividends. Now, they're not really dividends because they're not sharing with you the profits of a company that's doing business. They're actually trading options on the companies that are doing business. And then what they do is they give you the options premiums that they earn. All right. So we're going to talk about that. And I'm going to teach you how these funds do that. And they do that with synthetic long positions. So we're going to learn what that is. We're going to learn what a covered call is. We're going to learn what a cash secured put is. All right. So those are the three strategies that these guys use to make these big dividends, or these big, I don't like to call them dividends, I like to call them distributions. So that's how they make those big distributions, so that we can get these big premiums that come into us from these high yield funds, because they're trading options, and that's how they do it. So if they're trading options and we're going to buy into their funds, we want to know how they're doing what it is that they're doing. I'm going to teach you what they do, so you could do it yourself if you want to, but they're very good at it. And so they do it. We give them our money, and then they do it for us and then give us the profit. Of course, they take a little skim off the top, which is perfectly fine with me if they want to take a little profit off of it, if they're going to give me that kind of return, right? So that's why I think this is an important class for a lot of people, even though you might not ever want to really trade an option on your own, is so that you can understand how these high yield funds actually make their money. And I think that's important, because if you understand that, then you can better understand how to invest in their company or into their fund, so that you can manage your fund better, because you know what they're doing. All right. And I think that's important. Is it necessary? No, of course it's not necessary. You could just blindly do what you want. Just throw your money in the market and maybe some of it'll stick and you'll be okay. And there's strategies that we can teach you, and you don't have to know exactly what the fund is doing. But I think that by knowing what the fund is doing, I think that's very important. All right. So what I want to do is now I want to just simply come through and show you how to buy a call option. And that's easy. In Track and Trade, we make it so easy with this software. We're going to come into the control panel over here on the right-hand side, and up here on the top, you're going to see you have a tab called Options. So you click on that tab, and remember, whenever we buy an option, it's the earnest money that we're going to be buying. We have to specify an amount of time that it's going to take for us to take advantage of this opportunity. Now, what we're going to do is we're in this first scenario, in this first example, let's not think that we're going to actually take control of the stock. All right. We don't really want to own the stock. We just want to make money from the increase in value of the stock and have the options premium increase in value. Okay. So we can kind of guesstimate and make a pretty good guess of what that's going to be. You can run a little mathematical model and it'll tell you day to day what that's going to be, but it changes minute to minute. So we can do that from the expiration date. And so oftentimes what we do is we will tell you how much an option is going to be at expiration, because that's easy, because it's going to be the exact same value as the underlying stock itself, because one option represents 100 shares of stock. Now, if we wanted to come in here and buy 100 shares of stock right here, it's currently trading at $235 per share. Well, 100 shares would be $23,499. So $23,500 is what you'd have to put in there to buy 100 shares. Well, I don't want to have to invest $23,000 in Amazon. Okay, well, let's do it with an option. And we don't ever plan on taking possession of the underlying stock, so we don't have to ever come up with $23,000. We're just going to trade the options premium. All right. But the options premium goes up and down based on whether the stock goes up and down. So we have to decide whether we think this market's going to go up or down in value. Now, right now, this market's been going sideways after a nice 3-drive pattern. Okay. So here's our sideways trend. We have to do analysis on the market. We have to know, or do our very best swag, right? Our very best scientific wild ass guess. Nobody knows whether the market's going to go up or down, but we have recurring price patterns that kind of help us make these trend determining decisions. One of those patterns that we look for is an Elliott wave, right? So an Elliott wave is a 3-drive pattern. There's your trend, your first trend, your second trend. There's your counter trend, and there's your third trend. And when a market goes up through a 3-drive pattern like this, this is kind of telling you, hey, the odds of this market going up past 3 drives is really low. Doesn't mean it can't, certainly can. You know, you go to Las Vegas and you know the odds are generally not in your favor, but it doesn't mean you can't win a hand anyway now and again by going against the odds. But for us as traders, we don't want to go against the odds. Why would we do that? There might be times where you might want to go against the odds, because if you go against the odds, well, the payoff is much higher, right? So if you take a big risk, well, the payoff is big. You get a lot of money because you took a big risk. You got a bigger, much larger chance of losing than winning. Well, it's the same with trading options. If you take a great big risk, the chances of you winning are very low. But when you do, the payoff is really huge. All right. Now, most of us, I would recommend in the beginning, don't do that. All right. You don't want to be that guy. Don't run out there and trade the stock market as if it's a casino and you're, at the horse races betting on the fastest horse. It's probably not the best way to make a living or to supplement an income. We want to be putting the odds in our favor and take we don't want to take no odds, because that's not helpful either. If you're going to, only make $20 every month, that's not enough to live off of. So you have to kind of have that natural balance. We want to kind of put the odds in our favor a little bit, so that we have a higher opportunity of making money, but not so low that it's not enough money. It's not worth it, because we can win every single time, like 100%, 99% of the time we can win with options. We can have profitable options almost 100% of the time. But the amount of money you'd make could be so tiny that it would be, why would you bother doing it? All right. So there's a scale of how aggressive you want to be. And that scale is down here in your price chart. All right. So we're going to come down here. I'm going to pull up what we call the options chain. Okay. So the options chain is just the price of options at different price levels. So generally speaking, not most of the time, but I would say most of the time, a lot of the time, we're just going to buy the option at the current market price. So the current market price is now currently trading at 235. So we're going to come down here, and you can see in the options chain, you have down the left-hand side that says 235. So anything above 235, 252, that's when the market goes up, right? And anything below, that's down here. So you can see over here on the left-hand side of the screen, let me make it a little bigger for you. All right. So what you can see down here on the bottom left-hand side is this is just the strike prices. And strike price is just a fancy way of saying the market price. So you can see up here on the right-hand side of your chart, just on any normal chart, you see what the price of the stock is, 235. Well, that's the same thing all you're looking at down here. So strike prices are just the prices in which you can buy options at. So you can buy an option, and we're just going to say right now, we're going to say at the money. All right. So at the money means that we're going to buy one that's right on top of where the market's currently trading, which is 235. And you can see that the premium for that, you're going to have to pay $347 for that option. $347. Now that's for a 3-day option. And if you look at the drop down in here, this tells you how long your earnest money can last, right? So again, if you're doing a real estate example, you would say, well, I want 3 months to get my paperwork done, right? Well, we're going to do the same thing with our option. We're going to come in here and say, well, how long do you need before you're going to execute your right to take the underlying stock? Well, secretly, we're not going to really ever take the underlying stock. We're just going to buy and sell the premium of the option as it rises and falls or increases or decreases based on the movement of the underlying stock itself. So if the stock goes up and we buy a call, well, we're going to make money on our option as it goes up in value, right? Now, there's a little caveat to that, and we're going to talk about it on Wednesday, and I'll go into it in greater detail. I'll touch on it right now, but we're not going to touch it on a great length because it's something we're going to go into detail in class on Wednesday, but we're going to be talking about time value of money. All right. So we have time value as well. We have a decay. We have what we call intrinsic value and extrinsic value of an option. Now, just start letting that word kind of flood over you. Don't think you have to understand it today. You don't. We're not going to worry about intrinsic value and extrinsic value of options today, but we're going to get into that on Wednesday. And as Chad said, sometimes some of the little terms get a little bit more complicated as we go a little bit further in. But once you get all this stuff under your belt, it will make perfect sense. It's not going to be hard. All right, promise you. So make sure you come to class Wednesday and to the lab Thursday morning, where we'll work with the intrinsic and extrinsic value of options. Because you can hold on a second. I'm losing my voice here already. Because one of the caveats of trading options is that you can buy a call option and you can be right in the direction and the market can go up and you can still lose money. I know that kind of sucks, but it's part of the game. So that's why we have to do it, right? We have to understand how they work, because you can buy a call option. And in this case, a 3-day call. Do we think the market's going to go up in 3 days? It costs us $337. And then if the market went up, well, we would be able to make the amount of money between what we spent, $337, and whatever that increased in value. All right. But if the market doesn't go up fast enough, $340 can go away because you lose your earnest money if you don't buy the underlying stock, right? By the end of the time period. And if the stock hasn't gone up in those days, well, you can lose your $342, right? But the maximum amount of money you can lose is the premium you paid for it, which is $342. All right, so let's go out here. And this is kind of a 3-drive pattern. The market started to go sideways. It didn't really flush back all the way down to the 50% level like we were anticipating in here, did it? It kind of just went through this reaccumulation stage. That's what this is called, reaccumulation. So I'm going to pull up our map. We talked about the map last night. I didn't have a copy of it in class, so I want to show it to you today. This is the Wyckoff accumulation distribution model. Now, if you've taken my class before, you've seen me pull this up a million times, all right? So this is the map. I call it the map because it's kind of a map of what markets like have a tendency to do. Not this one. I like the other one better. Let's go with this one. All right. So this one here, you see where the market goes up through the 3 drive pattern, drive 1, counter trend, drive 2, counter trend, drive 3. So that's drive 1, counter trend, drive 2, counter trend, drive 3. Isn't it amazing that I already drew this map out and this market just happened to do that just like a train on rails? Isn't that crazy? I mean, I already had this map drawn, yet the market did exactly that. And that's because the market has a tendency to go through this because it's driven by large investors. All right. And again, I'm not going to go into great detail into the Wyckoff theory today because I've already done that in other videos. But for those of you who haven't seen this, this is just kind of an outline of markets have a tendency to do this. Now, as you see, we went up through the 3 drive pattern, then we go sideways, right? And we have, look, a little double top in there. I mean, it's almost perfectly drawn right there, little double top in here, right here. And then we expected a nice little ABC pattern down. Now we got our little ABC pattern down, A, B, C, D. We got that pattern right there. The thing is it didn't go down to the next one. It didn't come down here. It took off after that one and took off and went right back up, okay, which is fine. So this is the reaccumulation stage that it went through. It was real shallow. I like to see that come back farther down into the Fibonacci sweet spot. So I like to see that come back here a little bit further on here, but it didn't. It didn't come down in there. And why do I like to see it come back there a little bit further? Well, it gives us a better opportunity to buy the dips, right? Buy the low points. Now, our indicators down here that we've talked about in last class, our technical analysis class, showed that this is where you should be buying up this stock, right? Doing your dollar cost averaging, getting ready for the next rally. This is where the market took off, you can see, and this is where you sell out. You sell out. That's why it's red here. So you buy here on the way down. That's why this is green. You're supposed to be buying low and then selling high, right? Buy low, sell high. Anybody ever heard that statement before? Well, this is how you do it. You buy when this thing's green down in here, which is when the market's falling. Most people don't want to do that. They're like, I don't want to buy a stock that's falling, but that's when you buy a stock that's how you buy the dips and you dollar cost average down. You don't go all in like you're at a table of poker. You drift in a little bit at a time as the market's coming down, and it'll keep pulling your average price down. And that's why this is green down in here. All right. And then you sell out when it goes red up in here. So you buy low down here and you sell out up here, because if it turns around and falls back down, you didn't sell. Well, you didn't make any money, right? You have an average price down here, goes up here, you didn't sell, it fell down here, and you didn't make any money. So now you have to turn around and wait for it to go back up again. So you can do that. You can just sit and hold forever and hopefully the market will go up, but you're going to miss out on all those dips, buy the dips. Now you can continually to buy the dips and just add to your positions if you want to over a period of time, trade for a longer period of time. Lots of different strategies, lots of different ways to skin the same cat, right? So this is just one way of doing it, but we're going to do it with options now. So what we want to do is we want to come down and we want to kind of do our very best swag, our very best scientific wild ass guess at where we think this market's going to go. We don't want to just wag. We don't want to just make a wild ass guess that we think the market's going to go up. Oh, it's going up now. I guess it's going to go up some more. Maybe it's just going to be an ABC pattern. Maybe it's just going to come up, make this little pattern, and maybe it's going to go up like that. Or maybe it's going to turn around and just do this little pattern here. Maybe it'll come down. Maybe it'll start from the top and we'll come here, come up, break those blue lights and turn around and flush down one more time. And you're sitting there thinking it's going to go up really big when in reality it's going to come back down into the Fibonacci sweet spot down in here, right? It's just going to do it over here. Nobody knows. We don't know. I don't know. Land doesn't know. All I can do is say, well, the probabilities are at this point pretty neutral. We're not really extremely high. We're not really extremely low. We're kind of dead center of our decision point making, right? So that's what we call it. We call it decision point making, decision point trading. Okay, so kind of the center point of this is kind of right where the market's at right now. It's kind of right dead center of our sideways channel. So we might want to either, one, sit aside and not trade it because it's neutral. It's not really in an extreme low and look for a rally, or it's not an extreme high where we can look for a fall down. But we're going to place an order on here in anticipation because it's making higher highs and higher lows, right? Or at least it's making higher lows. So this is making a higher low. So that tells us this market is relatively bullish. So we're going to go with the bullish side. All right. So we're going to buy a call. Now, buying a call is very easy. There's you just buy it right at the money. We can buy the money. It's right there. It's $362, but that's only for 3 days. But we're going to have longer than that. So how long do we think we're going to need it for? Now, the longer you buy, the more time you buy. So if we come down here, you can say, well, I'm going to buy a 780-day option. Well, then it's $5,000, right? The longer time you buy, the more time you buy, the more money it costs. A 3-day option, well, that's cheap. It's only $360, but that's $100 a day. All right. So we're going to come in and we're going to do, again, we're going to go back and do a little bit of technical analysis. We're going to come in and make a mathematical calculation of how far we think this market's going to go before we're going to sell out of it. So I'm going to come in and I'm going to make some predictions. So I'm going to say, well, if it went up this far last time and it came down this far, well, if it goes the same distance from A to B as it goes from C to D, it would be right up in here. And so if it goes the same speed in which it did last time, the same volatility, it would take it that long to go again. So that would take, that's what this little tool does. It does this measure and count and measure for us, tells us the volatility of a market and measures the previous trend. And we anticipate the market's going to do the next trend. All right. So if it comes up to 100% of that last move, that would give us a target zone of about right in here, right? Which is not much higher than where it went before because it pulled back to almost as where it came down to the low. But if it goes up, it looks like it's going to be up there sometime around December 11th. If it maintains that same volatility, I can draw that right in there. I say at 100%, if it just does exactly what it did before, 100% would be, and it would happen based on the volatility because this little projection thing tells us price and time. I would anticipate December 11th is when it should be right up in the same region. Well, I know that today is December 3rd. So December 3rd from December 11th, I only need a couple of weeks worth of time. Plus, I might want to go out about 30 days because the market has a tendency to die faster. The options value dies faster. That's the extrinsic value. Has a tendency to die much faster towards the last 30 days. So I want to have that out in the future where I don't have to deal with that. So maybe I want to buy 2 months worth of time, right? Just to go to this level here and see if the market's not going to go up there and test this previous high. And if it does, I could buy 100 shares, but that's going to cost me $23,000. Well, I don't want to do that. So let's come in here and we'll go down. Let's do 45 days. So a 45-day option is $1,000. Well, that's a lot less than $23,000, and I still get to control 1,000 or 100 shares. So that gives me the right, but not the obligation to buy 100 shares of stock at $235 per share. But I don't have the obligation to do it just in case it doesn't go up there and test that 100% level and make me some money. So the maximum I could lose is $1,000. Now, I know $1,000 is a lot of money, but you don't have to wait for it to lose all $1,000. If it doesn't look like it's going to do what you want it to do and it starts to lose a little bit of money, well, go ahead and bail out early. Get some of your money back. You can do that. All right. Not like in an earnest money. If you bail out, well, you lose your earnest money. Well, that's not true in the futures or in the stock market. If you bail out of your options trade, you still get to keep part of your premium. You get some of it back. You don't have to lose it all. Okay. So that's another advantage of trading here in the stock market. All right. So we're going to go in here and we're going to place that order. Now, there's several ways you can do it in track and trade. And whatever trading platform you have, you're going to, there's different ways of putting your options on. Usually you have to go down into some table like this and you have to do all kinds of gyrations on your little application. You have to type in all kinds of stuff. Track and trade, you don't have to do that. All you do is you can do a little drag and drop right over here. See these buttons over here? You buy a call and you put it on there and notice that it drops. Immediately you click that button, it draws a little marker, little calculator there on the middle of the screen. And you bring your mouse over just like you do when you're buying and selling, and it moves with your mouse. And you can just move that option up and down on the screen. And each one of those options is a different strike price. All right. So this is a strike price way out of the money. So it's going to be a lot less expensive. This is a strike price way in the money. So it's going to be a lot more expensive. All right. It's already made a bunch of money. So the value is really high. Now we think the market's going to come up and test this previous high. So we're going to put our option right here at the current market price. Current market price is $235. So we want a $235 call. That's what that would be called because the strike price or the price of the underlying or the stock is $235. The market's currently trading at $235. So the at the money option is $235. Pretty simple stuff, right? So we have the strike prices over there on the left-hand side, and then the market is trading at 235. So that's the 235 strike price. So we're going to buy the market. We're going to buy the option right at the money, which is 235. All we have to do is just drag our little mouse right there, and we click on it. And when we click, it tells you over here, it tells you on the little calculator on the screen, it tells you how much you're going to pay. So you can see over here, we're going to pay $1,085, which corresponds with what was down in the table down below. And then you can see over here, we're modifying an Amazon 2026 0116. That's the expiration date, January 16th. A 235 call. We're going to buy one with an expiration of 45 days. Pretty simple stuff. It's right there laid out for you on the little calculator on the screen. So when we click our little calculator on the screen, we just left click the mouse. That's the order, and it comes over here and it fills out the order ticket. Now this is your order ticket in Track and Trade. Here it is right here on the right hand side. This is your order ticket. You can see it says Amazon 235. That's your 235 call, right? And it says that we got a 2026 116. That's the expiration date. It expires in 45 days. It's the 235 call right here. It's a call. We're going to buy to open, and we're going to buy quantity 1. Very easy. Now, Track and Trade lets you buy 4 of these at the same time on the same ticket. If you want to buy 8, well, then you'd have to do 2 tickets. But since we're only going to buy 4 different strike prices, now we could do a different quantity. We could do 10 of these if we wanted to. We'd go up and do 7, 8, 9, 10, right? We could buy 10 of these. It's still only one line. So we could do 10 here, 10 here, 10 here, 10 here, buy 40 options all on the same ticket. But we'd have to, but this one would be 10 on this line, 10 on this line, 10 on this line, 10 on this line to get 40 options. But that would be all at different strike prices, right? So each strike price is on a different line. But since we're only doing one line, we're all going to do them all on one strike price. We only have to put it on one line. You just leave these blank. It's okay. You just leave them blank. Now we're going to only do one. So we're going to take this back down to quantity 1. So we're going to do one option. We're going to buy one option. And we're going to buy a call. We're going to buy to open. All right. If you drop that little drop down, you can see you can buy to close, you can sell to open, or you can sell to close. But that's because we can buy an option, a call option, and we can sell a call option. So if you sell a call option and then you want to get rid of it, well, you have to buy to close. All right, because you sold it to open it. We'll get into it. Don't worry about it. It's not that complicated. Okay. It's just selling something that you bought, and it's buying something that you sold. Okay. So that's how we're going to do that. So we're going to go in here, and all we have to do now is we have a spread. Now, remember in last class, we talked about the spread, the bid-ask spread. You're going to an auction when you do options, just like you do when you buy shares. There's an auction. Now, most of the time you just hit buy, and it goes to the auction by itself, and it gets the worst price. Now, we don't want to necessarily get the worst price. We want to try and get a better price at the auction. So there's a bid and there's an ask. There's a buyer and there's a seller. The buyer, he wants to buy it at a lower price. The seller, he wants to sell it at a higher price. So you can see right now, the bid, what we're offering for this option is $10.75. Well, the ask is $10.85. So there's a 10-cent difference between there, and 10 cents times 100, that's a little bit of money. It's not a whole lot, but it's a little bit of money. And so you can offer something maybe halfway in between. So you can see the midpoint right here is 10.80. So the bid is 10.75. The ask is 10.85. Ask meaning they're asking, if you're going to buy it, you're going to bid 10.75. They're asking 10.85. Pretty simple stuff, just like an auction. But we're going to offer them a midpoint. We're not going to offer them what they're asking. We're going to offer them 10.80. And they're asking 10.85. So we'd come in here and we'd put this at 10.80. All right. Now the price is moving while you're doing this. So you have to kind of do it fast and be consistent and watch what's happening, because the market is changing these bid and asks while you're trading. But we're going to offer them. So now it's gone to 10.90 and the mid is 10.85. So if we do 10.80, that's the bid. We probably won't get filled. So now we are going to have to go up. We have to go up to 82. All right. Because they're asking 85. And we would hit that place order, and in this case it goes in and they're going to say, did it fill? So you can see in here your orders. You got a pending order, date 45 days, quantity 1, limits, all right in here. All the information is on your order, but this is pending. It's not filled yet. This is your positions. We have no positions, so this order has not filled. And you can see the little calculator that we put on the screen in Track and Trade in particular. See that little triangle right there? Because it's open, it's black. That means that your order didn't fill. A call option, when it fills, that'll turn purple, and when it fills with a put option, it'll be blue. All right, a light blue color. So you have different colors that kind of coordinate and with whether it's a call option or a put option, whether it's open or not, whether it's open or closed. So this is an open position right now. It's not filled, and that's because we offered them less money than they're willing to take for it. So we have to go back in and we have to make a new offer. So we can do that in one way. We can come in here and we can just right click here and say edit the order. Oh, they just filled it while we were sitting here. And then we go equity. We'd have to edit the order and go over here and change our ask to go up to what they're asking, give them a little bit more money. So you can sit there and play the bid-ask spread. But the bid-ask spread sits there, and it was closed, open, and so it filled our position now at what we offered. So we got a little bit better price, right? The market came down to our position and gave us the fill. So now you can see it's blue. That means it's filled because it's not black anymore. And the orders, this open orders is disappeared and came over here to positions. So now you have one position in the market. You have a 45-day call option and you have a cost of $1,000. That's all there is to it. You don't have to do anything now, but just sit and wait for the market to go up. If it doesn't go up, this premium will slowly go down. You start to lose money on it. Day after day, it'll go down. If this market just keeps going even sideways, if it just goes like this and hits that purple line underneath that green line, and that's the game you start to play, all right? If it's underneath that green line, well, you're losing money. But that green line also, when you buy an option, you have to pay for it, the value of itself, $1,000. So the market has to move $1,000 at expiration. Remember, we oftentimes do calculations at expiration because that's the easier calculation. But it has to be $1,000 before it'll start making money. It has to pay off the $1,000 because you just paid $1,000 for the option. So you have to make $1,000 before you even can start making money. Now, if the market takes off really fast, you can start making a lot of money very soon, and you don't have to wait till expiration for the $1,000 to decay away, right? For the $1,000. So we're going to take our little dollar calculator in here. It's real simple. We just come up here and we go to the purple line. We say, well, we have to be above this $1,000. So as long as the market stays above 1,065, 1,080, cost base 1,080. I got it set a little bit. That's good enough for horseshoes. 1,000. That's about as close as I can get. There we go. So there's your line. There's your break-even point. So the break-even point is kind of this little trajectory. See that? See how that goes up in value like that? How I drew that from where you bought this option up to where it hits the purple line, which is your expiration date or the drop dead date, right? So that little line right in there. Now we expect the market to explode and come up out of here because that's what it did before. We're going to say, well, it did it before, pulled back. Let's see if it'll do it again, right? But if it doesn't, well, it has to at least stay above that blue line just to break even. So it has to hit that purple line right there at that blue line just to break even. If it hits anywhere underneath that blue line, you're going to lose all your money. Okay, if it hits that purple line underneath that point right there, you're going to lose all your money. Now you can get out earlier and rescue some of your money, but you're going to lose all your money if it's underneath that line. All right, because it's going to pay $1,000 out under that line. Okay, so that's the name of the game. You have to pay for yourself. You have to pay for yourself. You have to pay for your option. So your profit potential is everything above there, right? Above here, out in here. I should make that green. That's your profit. So it's got to get up in there. Now, if it goes up faster, again, it's only at the red line, only at the purple line. So if it comes shooting way up here, that's okay. You'll make money a lot faster and you can take your money. If it goes up and busts up in there and then turns around and starts to come out, you might be wise to take your money right now, because if it flushes back down in here, it might turn before it turns around and comes back up again. It might hit the purple line. You don't have enough time for it to go up twice. So it's got to run hard and then turn around. If it turns around and comes back down, you lose your money again. So whatever money it makes, you got to get out, take it off. Okay. And you only have one, so you can't do like take one off, leave one on type of game. If you do 2 or 3 of them, you could do that. But that's the name of the game. We're just now the market needs to go up, and it needs to go up at least $1,000 so it pays for itself by expiration. If it doesn't, you lose money. Okay. All right. So we've just bought an option, a call option, in anticipation of the market going up on Amazon. So let's go over and do another one. Let's go to Google. Let's see what Google's doing. Let's go ahead and delete all of our drawing tools. And I'm going to turn off some of these just so it's not confusing. Some of my little cheat codes. All right. So there we got. Now this market has gone up. Oh my goodness. Look at all the drives on this market. Google has gone crazy. Okay. So it started down here and we had our accumulation stage down in here. And our accumulation stage looks like it ended right in here. Okay. Right in here. So this is our accumulation stage right through here. So we're going to go all the way out to like right there. Okay. So this is kind of the sideways accumulation stage. Then the market took off. And then how many drives did it make? Ooh, look at that. Drive 1, counter trend. Drive 2, counter trend. Drive 3, counter trend. We're on drive 4. That's like a unicorn, remember? 4 drive pattern. That's pretty rare. We don't get those very often. So do you want to be a buyer right here? Are you really excited to buy a bunch of Google right there? Ugh, that's scary. I'm not sure I want to buy some Google up there. What if Google decides it wants to make a little head and shoulders formation, right? A little head and shoulders out here like this. What if it comes down, makes a little head and shoulders, makes a little right shoulder, and then flushes back down? Half or 50% of the last major move. Let's start from the bottom of the trend. What if it comes back down even just to 38.2? Just gives us a little, but this is a Fibonacci sweet spot. That's where it generally comes to. But what if Google's just strong and it comes down and it does a little ABC and then comes down to 38.2? Well, we'd like to be a buyer here. We buy a little bit there. We could buy a little bit here. We could buy a little bit down here, right? Dollar cost average in as it comes down. If it doesn't come all the way down to 50.61 and starts to go back up in here, well, at least we'll have some, right? So you can buy a call option right here if you want to, if you think it's going to go up and continue higher. But the odds of that happening is starting to get really low. It's like, woo, I don't know if I want to be in that. It could be making another 3 drive pattern. It could go drive 1, drive 2, pull back and drive 3, and then flush out there. We don't know. That's why options are good. Options are good because you can have the right to buy the stock, but not the obligation. But of course, you got the premium that you're trading and you might make or lose the premium. So we're going to come in here and we're going to delete the arrows. Let's just delete all of our drawing tools. And so we're going to say, well, I think this market might come down. Now, it hasn't intercepted the blue light yet, and it's still going up pretty strong, but maybe I think that market's going to come down. So what I'm going to do is I want to try and make money on a falling market. So the way we would do that is we come into our options and we'd say, how much time do we have left? Well, let's do a little calculation with our mathematics. How long did it take last time to fall? If it went down, we'll use our little bar calculator. From this peak to this one, it took it about 25 days, right? So we could say a month. And then this one kind of went sideways for about the same amount of time, 20 days, 19 days. We could go back and look at some of the others, but right now we're in kind of this big uptrend. So we say, well, if it starts to go down, maybe it'd go down for another 20 days. All right. Before we catch it, we'll go sideways or down for 20, not going to go up for 20 days. All right. We could make that calculation. Again, it's a swag. It's a scientific wild ass guess. We don't know. There's just lots of tools that we can use to help us kind of look at what the market's been doing and try and make a decision point on whether it's going to continue higher at this point. All we know is it's gone up a lot. And every time it goes up that far, if we take a little measuring tool, right, just take a line and just measure it. Say, well, it went up from here to here. It went up that far last time. Is it going to go up that far this time? Well, it's already gone that far this time. Do I think it's going to go up again? Well, if it does, it's got to come down a little bit. It's got to make a little ABC pattern, maybe even go sideways before it even goes up again. Okay. So you can just measure using a stick. Now we got tools that do it, of course. So we come up here and we can put this in here and we can measure these. And you can see that on this one, it went from here to here. It pulled back, went to 37.7% back, and then it projected right up to 100% level again. That's why you want to use these little Fibonacci tools, because they're pretty good at making guesses. All right. They're pretty good wild ass guess tools. So we're going to make a wild ass guess that this market's not going to go up any higher. It's already hit 100%. Doesn't mean it can't. Certainly can. There's 130.9, which is a golden ratio, 161.8, which is also the golden Fibonacci number. And then we've got 200% out there. Pretty rare to see it go to 200%, but it doesn't. It doesn't mean it can't. But usually it'll come down and make another little ABC pattern first. So we'll see it come up here. It hit this ABC. And now we'll expect it to come down, maybe half or 50%. And what does it do? It makes what we call a little Fibonacci bow tie in here, right? So we go from this point here, this point, generally expect it to come back and tie that bow tie off at the same spot level. So that's kind of how we make our guesstimates. So we're going to say, well, I think we got a little downside potential on this market. Let's see. We're going to delete all this. We're going to come in and we're going to buy a put option this time. All right, so we're going to come into our options chain. We're just going to, again, buy it at the money right here. The market's currently trading at 315. Now we're going to go look at put options. All right, so we were looking at call options. Call options in track and trade are blue. Put options, they're pink. So that gives you a distinction. You know that you're not looking at the wrong ones. All right, so there's also one called the traditional view, which puts them both side by side. This is very common in most trading platforms, but it's a little bit confusing. And I'm trying to eliminate some of the confusion for you because you have both calls and puts at the same time. Now, that's nice when you're putting on some of these strategies where you buy a call and sell a put, or sell a put and buy a call, or you do some of these different iron condors and you put 2 on this side and 2 on that side. Then you can build them here in this little model right down here with both. But right now, all we're doing is just buying a put. So we don't need to have all this confusion. We just come and look at the puts all by themselves. All right. Now, I'm not going to go into all the stuff on this table. Everything out here on this table is very important, and there's a whole lot more stuff in here as well. You can see how much stuff you can put in there for options. There's all kinds of things that I have turned off to try and keep it a little simpler for you. So we're going to learn what those are on Wednesday. Wednesday's going to be a big day for us. We're going to learn a lot of really fun, neat stuff out here on probabilities, okay? Because that's what options are all about, is trading probabilities. But we want to look at the probabilities just by doing the technical analysis first, and then we can look at probabilities down here in the tables. But we learn that on Wednesday. So don't miss out on Wednesday and Thursday, all right? Make sure you come back. So again, here we're going to just do the at the money option, the one right at the same price as the current market price. So the current market price is 315 right now, and you can see that's where it's currently trading. So we come down here, and on the left-hand side it says 315, and these are put options, meaning that we'll make money if the market falls. So now, last time we used the little drag and drop tool, right? We came in here and we said we're going to buy a put. We did a buy a call last time. This would be buy a put, but we have to decide how much time we want first. Let's see, how much time did we decide? We're going to need at least 2, maybe 3 months in there. I like to buy a little extra time because I know it's a little bit more money, but markets, it gives me a little bit more time to work with. I have more time for the market to get to where I want it to be. Okay, so I buy some extra time, and that's okay. If it doesn't do what I want in a shorter period of time, I just get it back, and I get most of my money back anyway. Okay. So we're going to come in here, and this is the put option. And if we go out 45 days, that's $1,290. So we're going to buy that. Now, again, we can come up here and we can hit buy a put, and we can just drag the little calculator right on the screen, just like that, right? So we can put it right there, and we click the mouse, and it fills the table over here, fills up our little table. But I'm going to do something different. I'm going to cancel this one, get rid of that one. All right, it's gone. It didn't ever go to the market. This is just a screen calculator that you have to put it into the little table, and then you have to hit place order before it actually spends any money or sends it off. These are just little screen calculators for you, so you can line them up with areas of support and resistance. Oh, I want to be down here. Oh, I want to be up here, wherever you want your option at. But we want it right there at the money. It's the easiest one for us to understand right now. So we click the mouse, and it fills our table for us automatically right here. We don't have to type all that stuff in, because we know that's right where we want it. So we're going to hit cancel on this one, but I'm going to show you something else. You can come down here into this options table down here, and you can just right click the one you want. So we want that one that's highlighted in yellow. We're just going to right click it and say buy right there. So there's multiple ways to do it. And you'll notice that when you do that, it puts it up here on the screen. So now you have a little marker on the screen that shows you you're going to pay $1,287 for it. And you're modifying a Google 2026-0116. That's the expiration date. A $315 put, and you're going to buy one with an expiration date of 45 days. Pretty simple stuff. It's just right there. And then it's going to put that information over here in the table for you automatically, so you can hit place order and send that off to the exchange. Now, it doesn't go off to the exchange until you hit that place order. So you can sit here and mess around with it and play with it and move it around and do whatever you want with it until you hit that button, until you hit place order. So now we're going to come in, and we're going to go like this. We can move it down here in this window too. What if we want to move it down? Well, we can drag it down here, and we can move it down here in this window. So that's really cool. You can move it up in this window down here. Okay, so we can put it in or out of the money just by dragging it down here. So we can do it, drag it down here, or we can drag it up here, either one. It doesn't matter. And it adjusts it in both places. All right. So you can see down here, we got this highlighted down here. That's where it's at. or you can put it right back up here where it's at, whichever is easier for you. If you like to look at the table, you say, well, I want to just do it down here, or you can drag and drop it up on the screen, but either way, it's going to build your model up here on the screen. And the reason this is important is because sometimes you want to buy a call here, you want to buy a call here, you want to buy a put here, and you want to buy a put here. And so now you got this model built on the screen, and you can see it both in both locations. You can see it both down here in the table, and you can also see it up on the screen up on top. All right, so we're buying calls and puts, all four simultaneously. Like I said, we can do up to 4 of them at the same time, and there'd be reasons why we might want to do something like that. And you can see the model on the screen, and so you can make predictions of where the market has to go based on your model, and it has to go to certain levels by the purple line. And if you don't see that, if you can't see that, it's very extremely difficult to trade options without having that model built on the screen so you can see it. And that's one of the great advantages of Track and Trade, and why it's won Stocks and Commodities Annual Reader's Choice Award 7 times. It's a great tool for doing this. And when option strategies get a little bit complicated, a little bit sophisticated, you want to be able to see these models in relationship to where you think the market's going to go, because that's how you make money, is where you determine that the market's going to go based on where your options are going to be put for maximizing your profit potential. All right. And I know it sounds a little complicated, but I'm not telling you to do that and learn that right now. I'm just showing you that that's the possibility, and that's the creativity of the software, and giving you the ability to make those projections and take advantage of them with multiple tools, okay, simultaneously. And then, of course, all the math is done over here for you so that you can see where your costs are. All right. So let's go ahead and clear all that out, and we'll cancel all those and get those off the screen. And now what we're going to do is we're going to come back and just do our simple little put option, because we think the market's going to fall. We're going to do 45 days out. We're just going to come down here, right click, say buy the order. There we go. Now we got a put option. Now we come over here. What's the bid? The bid is 1265. The ask is 1280. This is 1273. We're going to go to the ask. I'm just going to raise it up and offer them what they want, which is 1290 right now. And you can see this is the spread. That's going to be a cost of doing business. You see it's going to cost me $10 on the spread. That's not a commission. Now in the stock market, in Track and Trade with the brokerage firm, there is no commissions on options. This is a commission-free trade, but you still have the spread, the difference between the bid and the ask. So that's a cost of doing business, and sometimes that can get expensive. On this one here, we're up to 85. So at 85, that's $20. It's not a commission, it's the spread. It's the difference between buying and selling the option at the bid or the ask. So there's $20 that the market wants to take away from you to place this order at the ask price. So we're going to go ahead and place the order, and that should fill. And there it goes. It filled. And it filled right there at the money. So now what we want with this one, because we bought a put option, we want the market to fall, because that's how we're going to make money. Now, by expiration, it has to fall at least $1,275 to break even, right? So that's our cost. So it has to be down here to make us enough money to break even. $1,275. Anything above there, we're gonna lose money. All right. So we don't want to lose our money. So 1,275, and we're going to take this little dollar calculator, and we're going to go from here. And we're going to go down to 1,275, 1,275, 1,275, right about there. Not too bad. It only has to fall that far by expiration to break even. So anything below that is going to be gravy train, right? All this is profit. Anything down here. How much could that be, Lan? Well, it could be a lot of money. What if it fell all the way from there to here? That would be $11,000. That would be $6,000. That would be $10,000. Okay, so let's go to $10,000. So that would be $10,000 move right there. What if it came to right there? You'd make $10,000 minus the premium, $1,270. So you'd make $9,000, roughly $8,900 and something dollars right in there if it came all the way down to there. Now it's probably not going to fall that far, but what if it fell just to here? Well, that'd be $5,000, $4,500 minus your premium. $1,266, but you got $5,039. That'd be $5,000 right there, $4,000 before the $5,000, about right there. That's a lot of money for only putting up $1,267, but you have to pay for your premium. All right, you have to pay for that. So that has to be made. It has to be at least to there, and then anything after that, it's just a gravy train. Make all kinds of money. Be rich, rich, rich beyond your wildest dreams. All right, if you're right, you have to be right though. Because if it turns and goes up, what do? Well, you lose your premium. You lose the $1,265. So And of course, you don't lose it unless you hold it all the way to the purple line. If you hold it all the way to the purple line, well, then you lose your 1,265. But you can get out early. You can get out up here and only lose maybe half of it. All right. So that's the name of the game. We just bought a put option. Now let's come in here. Let's go to another one. Let's come down here to Meta. What's Meta doing? Oh my goodness. We got lots of drawings on Meta. Let's delete those out. Oh, Meta's getting ready to, looks like to me, Meta's criteria for being a rally. So we come in here and draw our Fibonacci ruler across there. And it's right dead center. It came right down into the Fibonacci sweet spot, just like a train on rails, right? Just like we're expecting the other markets to do. So it's already gone up. It's a little ahead of everybody. If we bring up our little map here, you can see that it followed it just exactly. So it went up, it had your accumulation stage over here, which is here. I don't know if I can make it wider. Can I do that? Ooh, nope, doesn't work like that. Okay, so it went through the accumulation stage here. It went up through our 3-drive pattern, drive 1, drive 2, drive 3. Not as pretty, but kind of had a little jug and jog in there. But nonetheless, we have our 3-drive pattern to the top. There's drive 1, drive 2, drive 3. We had our little peak right there. This is this peak right here. This little peak right here is this little peak right here. And then down it went. Little ABC off the top, right back down into the Fibonacci sweet spot. Just like the map. Oh my gosh, Lan. When did you draw that map? Oh, I didn't draw that map. Richard Wyckoff did about 50 years ago. And markets are still doing it. Crazy, isn't it? All right. He drew this map about 50 years ago. So that's our Wyckoff map. So that's what we do. That's how we measure these things. And that's how we make money, is because we have a map. We have a map to the market. And if it follows that, you can tell when it's following that. Sometimes it doesn't follow it. Sometimes you're like, it's not doing that at all. Okay, well, don't trade that market then. We want to trade the ones that are doing this. And if they're doing this, they're pretty predictable. Which markets do that, Lan? Well, most of the great big markets, because they're the ones that are manipulated by the great big hedge funds and banks. And it's the big hedge funds and banks that trade this way. So they make the market do this. So that's just naturally how the market moves when the big banks and hedge funds trade it. And we can go into deeper Wyckoff theory about why this happens, but for now, just know that it does. And so this is coming down into the halfway mark, right down into the Fibonacci sweet spot, back into the reaccumulation stage right here, and it's starting to break out, isn't it? Starting to break out and go make one of these little jigs and jogs in here. So it's breaking those blue lights right at the perfect spot. Could it go down one more? Sure, it could. What's the other model? The other model is that it could come down one more. All right. This model draws it out a little farther. So it says, well, it could go through here and then it could flush one more time and come all the way back down and touch this even number here. So there's always that chance, all right, before it turns and goes back up. See how this one is the same level as this one. This would be considered a neutral market. This one here, this model is considered a bullish market. And the reason it's a bullish market is because this is way lower than this one. Came down only halfway and then turned around and started to go back up. So this is a bullish market, right? ABC pattern. A, B, C, D. Take off. So this one went all the way to the bottom, okay? All the way to the bottom. I don't think it's going to do that. I think we're in good shape here. I think we're going to go from here back up. Unless something catastrophic happens, we're at the 50% level. It could go down one more. I mean, it definitely could. I'm just a swag, right? This is your ABC pattern, and it come right down here to 200%, just like a train on rails. Now it could go down one more. We could come in here, and we could say it's going to come here, 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 and it would come right back down to this lower level, just like that second map that we drew, right? So there is the chance it could just make this little thing here and then come back down. So that would be an opportunity maybe to buy an option in case you think it's going to go up or down. You're like, but Lan, I don't know if it's going to go up or down from here. It could continue to go up. It's already made 4 drives. We'll probably get a little bit of a down if it's going to continue up, something like that, right? Maybe not, though. It might just go straight up like nobody knows. All right. We can make all kinds of guesses, but at some point, if you want to try and make money off of it, you have to make a decision. So what we can do is we say, well, I don't want to make a decision. Okay, well, you can come in here and you can say, well, let's go out another 80 days and give us a little bit of time to work with here. And we can come in and we can buy a call right here, and we can buy a put at the exact same price. Now what happens? You have a call and a put. So you'll make money if the market goes up, or you'll make money if the market goes down. That's called a straddle. Okay. That's called a straddle. So we're straddling the market. We're going to make money if the market goes up. We're going to make money if the market goes down. Remember, we can put 4 of these on here at the same time. Now I've put 2 on. So I'm going to make money on the call going up. I can make money on the put going down, and I can place both of those orders at the same time. It's called a straddle. Now, how do you make money with that? Well, these are pretty expensive because Meta is really expensive. It's a $644 per share stock. So this is expensive. $80 days out. That's $4,000 for the call, $4,000 for the put. This might be a time where we go to the traditional, and you can see we got a put and a call, one on each side. See that down here? We got one at it's going to cost at the $645 strike price. So we got one at 4,000 and we got one at 4,000 over here. 4,700 for the call, 4,100 for the put. Why is the call so much more expensive? Well, because the market's already going up. Remember in class last night, I said, well, if the market's going to already go up, they're going to charge you more for it because you're saying, I want to make money when the market goes up. Well, it's already going up. So they're going to charge you more for it. You're going to say, well, I want to make money when the market goes down, but the market's going up, so they don't charge you as much for it. They're going to say, oh, well, market's going up and you want to make money on the market going down. You're probably going to lose money, right? But you're like, well, maybe not. Maybe I'll make money. But the thing is remember, the market has to go far enough to pay for the premiums of the options that you buy. So you got 4,000 on this one, 4,000 on that one, and you put this order on, the market's got to move at least $8,000 to get to break even by expiration. But expiration's way out here. Right, it's clear out there. So it can still make money going up or down as long as the one that's making money makes more money than the one that's losing money. See how that goes? Kind of weird, kind of crazy, kind of fun, but you could do that. You could do that. So let's put that one on. So we're going to go in here and we're going to go, I'm just going to do this, see if they'll let me mark it into it. And yeah, okay, we got our order. So it filled both of those. Now when we come into our positions and we say on this particular chart, we got Meta, we got 2 orders. We got one that's going to make money when the market goes up. We got one that makes money when the market goes down. We got a cost basis of $8,800. That's okay. Let's play it. Let's leave it on there and see what happens. That's how you learn. You come and you put these on and you say, I got an idea. What if I put one of these here and one of these here? Or what if I put one of these here and one of these here? Well, you got a simulator here. You go put it on and see what happens. And then you're like, man, I've done that 10 times and it's made money every single time. Well, go put it on in the real money account then. Do it with real money. That's how you win. That's how you learn. So you get the software and you just start playing with it. You can't break it. Might as well try some stuff, right? That's how you learn. Come to Microsoft, we do the same thing. We come down here, we do all of our technical analysis, we come back to the 50% level. Oh my gosh, look at this. I think the market's just going to go up from here. It's breaking the blue lights. Well, it might not. It might come down and make a little ABC pattern, break those blue lights and come back down here. Ooh, you're right. It might do that. But I think it's going to go up. Okay, well, if you have conviction that it's going to go up, very easy. Just come in here to the options, go out 45 days, 80 days, how long you want. What's the options strategy? Come down here to the calls. Call costs you $1,752 at 45 days. Well, what does an 80-day option cost you? $2,700. Not that much more, and you get twice as much time. Well, let's do that one then. You hit buy on that one. There you go. You got your option. You come in here, just hit a market order. Away you go, and you got your position on. There you go. You're long the market. Now you're controlling $50,000 worth of Microsoft for the cost of $2,700 because it's an option. You have the right, but not the obligation to buy 100 shares of Microsoft at $491. If it doesn't go up, well, you start to lose a little bit of money against your $2,700, but probably not as much as you'd have lost if you'd had 100 shares at $491. It started to go down. So your risk is a lot less and your profit potential is the same, right? And actually it's higher because you're only putting up $2,700. You're not putting up $49,000. So if you only put up $2,700 and your profit potential is the same, that's a tremendous amount of leverage. And that's why we trade options, right? And again, we don't have to take advantage of, we don't have to exercise our option and take the stock underneath. We'll just liquidate it, get out of it before the purple line. Because you have to make the decision by the purple line on whether you're going to buy the shares or not. If you're not going to buy the shares, well, then you're going to lose the $2,747. Or you're going to get rid of it, liquidate it, take it off, and take the profit that the option has increased in value as the market went up in value. But you do have that break-even point. Remember, you got to go from here to here. And where's that break-even point? $2,700. So it's about right there. So that's your line. You want the market to stay. You want the market to stay above that kind of that little trend line right there. See that? So as long as the market starts to rally and it's up here, anywhere above here, it's going to show a profit. This is all profit zone. Down here, it's going to show a loss. Down here, you're going to lose all of it. All right. Anything below here, you're going to lose everything. All $2,700. All right. By the time you hit here, if it doesn't pay for all of it, well, you're going to lose some, and then you're going to lose all of it down here. So anything above that little line right there, that's pure profit. Pure profit, as high as it can go. You want it to be way up here, right? Because that's going to give you lots of money up there. How much would it be if it went up there? Well, it would be $10,000 if it went up there, minus your $2,700. So that would be your profit potential. All right, guys, that's how it's done. Pretty simple stuff, right? Don't make it more complicated than it is. We're going to make it more complicated on Wednesday. Actually, we're going to clear up some of the confusion on Wednesday, because the more knowledge you have, the more understanding you have of how things work, the more clear the picture becomes. So every day we're going to make the picture a little bit more clear, a little bit more clear. You're still missing some components here. All right. There's still some pieces of this that you're missing. So make sure you come to class on Wednesday at the university and the lab on Thursday morning. Now, tomorrow we're going to have a lab too, but it's going to be at 1 o'clock in the afternoon, and we're going to be doing some day trading. For those of you who are still part of the day trading class, we'll see you tomorrow afternoon. All right. At 1 o'clock. So here is the software I'm using.
Okay, this is the software I use. It's called Track and Trade. They've got two versions, one for stocks, one for futures. This is the website, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, so that's where you're going to go get the software so you can do this with me. And then we're just going to keep doing these things. We'll just keep going and going. I know class will end on Friday, but that's okay. I'm going to just keep doing more labs. I'll just keep doing more labs, and we'll just keep doing more labs. We'll keep looking at more charts. We'll keep doing more things. And you guys just stick here with me. And those of you who are serious about doing this, you're going to just learn more and more and more and more and more. That's how it works. And we'll just keep working together. You can call me and you can ask me questions, and I'm not going to go anywhere. I'm still going to be here to help you. Just because class is over doesn't mean I'm not going to be here to help you. I'm going to be here to help you. All right. All right, if you have any questions, let me know, and we will see you guys tomorrow afternoon at 1 o'clock, and we'll do a little day trading just for fun, all right? We'll see you then. Before I hang up, I want to look and see if anybody had any questions in here. Just call Google when you talk about it. Look good. Thank you. Jay just went and put an option on Google. These are not trade recommendations, guys. These were not trade recommendations. All right, not trade recommendations. How you doing, Lowdown Killer? It's good to see you, man. All right, these are just examples, guys. These are not trade recommendations. Okay, we'll see you guys later. Take care. Have a good morning.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.